at the simplest level, I think about it from the people providing you the money. If I'm providing money on the debt side, so if I'm the lender, I'm giving you money and I'm worried about kind of my downside risk, right? So the best case scenario, I give you $10 million and over the course of 5, 7, 10 years, et cetera, you're providing me a rate of return, right? The interest rate, let's say it's 5, 7%. And by the end of that, you pay me back. So ultimate scenario is everything goes well and I get my $10 million back and I get, 5, 7% a year for the time that you have that money. On the equity side, if I'm providing equity to your project, yes, I want a rate of return, and that, whether it's mezzanine or pref equity, there's stuff there. I'll get some rate of return. It's obviously higher than debt, but I'm also going to take part in the upside, right? So I don't just want you to operate the business and pay back the debt. I'm hoping that you raise rents, there's cap rate compression, and that as the value of that building goes up, whether it's in kind of the waterfall or the way that we kind of distribute returns, that some of that upside is going to go back to me. So ultimately, the debt side, they've got no upside, right? They're just like, let's just have things go optimal and let me get my money back. And I'm going to charge you a rate of return that reflects the risk that things go wrong. The equity, obviously there's a little bit more risk there depending how it's structured, but they're in it for the upside. So when I think about projects, to balance between the two, anecdotally, depending on where the market is, depending on how you structure the equity, equity can be more expensive, right? Because equity, you're going to give away some of that upside. So depending on how you're thinking about it, bringing in more equity into the deal, bringing in more equity partners, it's great, right? Because you can limit the amount of capital you've got to put in that project. But there's a trade-off there. So if my $10 million building becomes worth $15 million and we've got $5 million of appreciation, depending on how we structure the equity, those equity partners are going to want part of that $5 million. Or if I did the deal all debt, as long as I pay back the $10 million I borrowed, that $5 million is mine. So debt and equity and kind of placing that all together is just, finding out, that's why we model the deals, finding out, who's going to allow you to get the most capital to win the deal or purchase the deal, and ultimately what can provide you and your investors the most in returns, whether that be a combination of equity and appreciation and cash flow.